Hello, everyone. Happy new month and welcome to the weekly roundup. Today, we will cover the upcoming elections, FOMC rate decisions, and earnings releases. Hello, Ben.
Hey Eva, happy Friday.
Happy Friday. How was Halloween?
We had 250 kids, so it was good turnout.
Oh, wow.
Yeah,
That's a lot of
yeah,
kids
yeah.
and a lot of
Kid,
candy.
yes, exactly. And my three had fun as well.
Great.
Yeah.
Okay. Let's start off with the fun stuff. The race to the White House, Tuesday's federal election. What are your general thoughts and what's market saying? What's the reaction so far?
Yeah, it really does appear to be a toss-up again. I feel like it's a broken record as we come to election time. The last multiple presidential cycles, it's been a really coin toss coming into it. It just really shows how divided the country is. And so we'll say the markets, there's two kind of areas that seem to be suggesting that Trump is in the leadership position right now. From the perspective is we've seen, once his, we'll say, polls started tilted over that 50% mark, you started to see bond yields start to rise with the view that fiscal spend will be pretty heavy, as well as further tax cuts, whether corporate, personally, those kinds of discussions that he's made. And so fiscal irresponsible seems to be jumping up. The other area has been oil. Oil sold off the past couple of weeks. And that's been on the back of a number of things. Some people say it's Israel-Iran settling, but I think it has more to do with the view that he would prime the pumps and try to keep energy prices low so that the consumer spends and that juices the economy. So markets seems to be signaling, at least the market participants expect that he's going to win. If you read other political pundits, though, I think it's they still have that view that Harris has a better chance. So I'd say market's saying one thing, but certainly gonna be an exciting week next week.
Sure.
Yeah.
Let's flip to the monetary policy side. The FOMC meeting is next week.
Yeah.
What is market expectation on rate decisions?
Yeah, so right now pricing 95% chance that they're going to cut 25 basis points. And so uh, I think if the jobs numbers that came out this morning in the US had come out in Canada with similar numbers, we'd certainly see 50 basis points. The jobs market was actually pretty weak, so we had downward revision for the previous 2 months, but we also had I'll say, a job pickup of 12,000 jobs, which is the lowest level since December of 2020. And so it's certainly a low print. I mean, the optimists say 46 months in a row of jobs being added to the economy. The pessimist says, well, we've had revisions for the last 6 months, so there's no doubt that this will be revised in the next update as well. So pretty light on the jobs. Ultimately, I don't think it changes anything. We're going to see 25 basis points on Thursday, which is a change because the election's on Tuesday. Usually they come out on Wednesdays. So I'd say 25 basis points market is saying right now.
Okay. Earnings season, we're in full swing, from the tech giants to the health stocks. Could you run us through some numbers and market sentiments?
Yeah, so we had a couple of the heavyweights for sure. We had Google, Microsoft, Meta, and then Amazon this morning. I'd say those are kind of the four biggest this week, with the exception of Nvidia, of course, which hasn't yet. But those four were big. Microsoft and Meta, we're talking about their investment heavy investment in AI. Microsoft, who knows? Obviously, they're committed to ChatGPT with their partnership with Open AI. And so they'll continue to commit to that. I don't see why they wouldn't. ChatGPT seems to have a lot of attention, a lot of companies building on top of their platform, around their platform. So I'd say they're certainly doing a good job there. I think the CEO and maybe some of the company doesn't like to spend. But on Meta's side, Zuckerberg drives the train there. And so for he doesn't really care. If he believes that something's going a certain way, then they put the money and time and attention towards it. There's a reason he maintains control of the company, and he owns 51% of the voting rights for a reason. And so he'll steer the ship wherever he thinks necessary. So heavy investment in AI. So they missed a little bit from the perspective is the market didn't really like that. Their stocks were both down. Google had good earnings on Monday, and then Amazon last night, pretty positive earnings. Market liked it. It was up 6 or 7% at the open. Now I think it's a little bit less than that as the market's corrected a little bit into the afternoon here. But generally, the market liked Amazon. Consumer sentiment pick up this week, plus their cloud services continue to do quite well.
Good. Anything else catch your eye this week?
Um, so I always know you're going to ask me that question, see if there's something earth-shattering that caught my attention. But
Yeah.
really, this week, all the focus has been on what's coming ahead with the presidency next week. Lots of conversations about the potential possibilities of good things or potential risks of bad things. And so lots of conversations around the economy, like wars,
Yeah.
yeah, geopolitics, all those kinds of things. So that's been the primary focus this week.
Okay.
Yeah.
Any changes to the portfolio?
So continue on that move, shifting away from sovereigns to corporates. So continue further trading with that this week, which is continuing to kind of try to reduce interest rate risk and move to higher yielding. You know, for years and probably decades, I had this view that sovereign debt would rally as the economy slows. And I remember reading something like 5 or 6 years ago there fixed income analyst was talking about money's going to shift from sovereigns to corporates because corporates are actually going to be safer than sovereigns. Took me a long time to get my head around that, but I think I'm starting to see it as well because the corporations are much more fiscally responsible than the governments are right now. So we've been making that shift as a result.
Okay. Yeah. Sounds good. Let's go into the charts.
All right. November 1st, first day of the new fiscal year for the banks. All right. So just a couple comments. I'll talk a little bit just on the jobs and then a few other pieces, election, things like that. But this is just a look at the U.S. non-farm payroll. So it just shows you where the jobs have either and or been lost or created. So not a lot of places. So as I mentioned here, if you look this little area, that's 12,000 jobs. If you look at the places where it's been I'd say if you look at the positives, a little bit in construction, a little bit in healthcare, education, and then the other areas where we're seeing pretty negative was durable goods. Pretty negative. We see professional services pretty negative as well. And for the first time in a long time, you see leisure and hospitality on the negative side of things. So those were the areas that certainly jumped out to me. And just the divergence here, of course, because this was September jobs, and this is now October. That's a pretty dramatic decrease. And so just a couple comments on the fiscal debt. As you know, it's not going anywhere but up at this point. So if we look on the left side of this is in trillions of dollars. So this is $32.5 trillion, we'll say, is the public debt in the United States at the present time. And the red line is the year-over-year change in it. So, we've talked about this a little bit, but the U.S. effectively spends $2 trillion more a year than they make. Foreign governments maybe buy 10% of that, 200 billion. The rest of it gets sopped up by the central bank. So, we get this massive debt that continues to run, to my point about sovereign risk right now, but also to the view that rates continue to climb, and I don't think there's any way out besides the debt jubilee, which we could discuss another day. But I thought this is a worthwhile chart just to look at it from the perspective of what debt looks like. So a little bit on oil and gas. There's lots of things to cover on it, lots of risk and or opportunities, we'll say. So there is and was some risk that Israel would bomb Iran further and potentially target the oil and gas facilities. So this is a reasonable expectation for what could potentially happen. You're looking at something in the neighborhood of 450,000 barrels a day in this area here. You look at total output per day, so you're looking at something around just under 2 million barrels a day. So it's significant. It's worthwhile. Certainly, there's not a lot of risk presently priced into it. But if their facilities went offline for a while, potential spike in prices at some point. So it's worthwhile continuing to pay attention to some of the risks associated in the oil and gas market, and an area that I think offers a pretty reasonable risk return at this present level. So, as we just talked, two more quick slides just on the US election. I talked a little bit up at the top, but this is just a reminder around how the US elections work. In order to win, you need 270 electoral votes. And so each state, if you look at this here, Alabama to Wyoming, each state has a different number of votes. So in order to win 270 of a total of 538 electoral votes, you need to win in these different states. You can see the breakdown. Obviously, the largest one is Texas in this case, so that gets factored out. But this is how you need to win 270 votes, electoral votes, in order to win a majority. And so, there's a lot of talk about the battleground states: Georgia, North Carolina, Pennsylvania, Michigan, Wisconsin, Nevada, Arizona. So those are kind of the key states that the candidates have been trying to focus on here. Always take a long time. Georgia's always one of the last to report, and this may take some time, but it's going to be interesting to see how it plays out. What happens between now and then. We got 4 days. I guess the election's on Tuesday next week. And this will be worth watching and paying attention to, as these are kind of the major states that are going to come into play to decide who's going to win the election this year.
Great. I'm going to ask you what's on the agenda for next week, but I'm going to say X the elections.
Yeah, exactly. So I'd say let's see what kind of follow through there is from some of the numbers that came out this week, because we get that continued mixed readings, like I've been saying. Consumer sentiment came in quite good, but the jobs number came in quite soft. And so we continue to have this mixed numbers that are coming through. And so I think that'll be worth watching. And the other piece, which is liquidity, which we didn't talk too much about. I did reference it a little bit in the daily today. Is that in January of next year we have the debt ceiling starting to come back into play. Which what happens at that point too is the Treasury starts to put more money in the system from the general account. So liquidity is going to be important to watch as well. X the elections.
Absolutely. Thank you so much, Ben.
Yep.
Please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Also, please visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group, and our daily blog, Daily Heartbeats, for everything financial. Thank you very much for listening and have a great weekend. Bye.
Thanks, everybody. Take care.